Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. Thank you so much for joining. If you're on YouTube, please subscribe, please like. Again, if you end up finding this helpful, please like and subscribe on YouTube. We'd really appreciate that. The presentation is being provided for educational purposes only. It should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So we do go live every day, twice a day. This is our afternoon session. We were here earlier at 10 a.m. Pacific, 1 p.m. Eastern. This is our afternoon session of 1 p.m. Pacific, 4 p.m. Eastern. If you subscribe to our YouTube channel, you'll get those notifications. You'll be able to jump on to the live session, ask questions, etc. So for example, today we want to talk about solo 401k versus SEP IRA, which is right for you. Tomorrow we'll be back with more topics. For example, mega backdoor Roth solo 401k versus backdoor Roth IRA. And then in the afternoon, we'll be talking about Vanguard to a census solo 401k reporting, what to look for. So again, we want to jump in and talk about solo 401k versus SEP IRA. So let's start to talk about that. And then I see we've got some questions, which is fantastic. Feel free to chat over more questions. We want to spend a little time on the prepared content though. So for those that are self-employed, they might be looking at a couple of different options, one being a solo 401k versus a SEP IRA. So you have to be self-employed to set up both. To set up a solo 401k, you got to be self-employed with no non-owner, non-spouse, full-time W-2 employees. So for those individuals who are eligible to set up both, they're almost always going to choose the solo 401k. So let's talk about why that is. And it comes down to the features and therefore the benefits. So in terms of some of the key features to consider, number one, of course, is going to be contributions, because really the purpose of any retirement account is to save money for retirement. And so a solo 401k is going to have much higher contribution limits, or I should say it's easier to hit the overall limits. Right? It's easier to maximize contributions. So effectively for most individuals, that means that it has higher contribution limits. You can contribute more to a solo 401k because you can contribute more based on the income that you have versus a SEP IRA for most individuals. If you're in a really high income situation, you're going to be able to contribute the same to both a solo 401k and a SEP IRA. But if your goal, for example, is to make Roth contributions, right? You've got the mega backdoor Roth with a solo 401k that's not available under a SEP IRA. So the reason that the contribution benefits are different for a solo 401k is because you have multiple buckets that you can fill up with the solo 401k. With the SEP IRA, the only type of contribution that you can make is the employer contribution. And you can make that same employer contribution to a solo 401k. But in addition, you can also make employee contributions. In addition, you can also make voluntary after-tax contributions, which is how one makes mega backdoor Roth contributions. So the employer contribution, whether it's being made to a solo 401k or a SEP IRA, it's always going to be a percentage of your self-employment compensation. So what that percentage is depends on how your business is taxed. If your business is taxed as an S corporation, your ability to contribute to both the solo 401k and a SEP IRA is based on the W-2 wages, and that employer contribution limit is 25% of your W-2 wages. So for every dollar that you want to contribute to the solo 401k, you have to have 4 times that amount. Or every dollar you want to contribute to the SEP IRA, you have to have 4 times that amount if you're referring to making employer contributions. Now, if your business is taxed as a sole proprietorship, your ability to contribute is based off of self-employment compensation, where self-employment compensation is equal to your net income, right, after your business expenses, etc., reported on line 31 of Schedule C, less 1/2 of the self-employment tax. So you got to run a pre-calculation. And then the employer contribution limit is 20% of that amount, regardless of whether it's going to a solo 401k or a SEP IRA. But that's it. That's the only type of contribution you can make to a SEP IRA. Whereas with the solo 401k, you can also make employee contributions. You can also make after-tax contributions. And those employee and after-tax contribution limits are not a percentage. So you can contribute 100% of your self-employment compensation up to those applicable limits. So for example, for 2025, the employee limit is 100% of your self-employment compensation, dollar for dollar, up to $23,500. And then if you're age 50 or older, you can also make additional contributions based on your income, right? So 100% of your self-employment compensation up to $23,500 plus an additional $7,500 if you're age 50 or older, or instead of $7,500 if you're age 60 to 63, you can now do a super catch-up contribution, which is $11,250. So you can fill up that employee bucket 100% dollar for dollar to the solo 401k, whereas you can't make that employee contribution to a SEP IRA. And then if you have a plan like ours that allows it, you can make voluntary after-tax contributions to the solo 401k, which again, the voluntary after-tax contribution limit is not a percentage. So unlike the SEP IRA employer contribution limit, where it's a percentage of your self-employment compensation, you can contribute 100% dollar for dollar up to the overall limit. So let's take a simple example. Let's say you're under 50. Let's say your self-employed business is taxed as an S corporation. For 2025, if you have at least $70,000 of W-2 wages, you could contribute 100% dollar for dollar as a Roth and then mega backdoor Roth contributions all the way up to $70,000. Whereas with a SEP IRA, you're only going to be able to contribute 25% of those W-2 wages as a SEP IRA contribution. And then you're capped out. Then you're done. So from a contributions perspective, whether the individual is looking to make pre-tax contributions or looking to make Roth or mega backdoor Roth contributions, the solo 401k is going to be much more advantageous versus the SEP IRA. Now, other features that are relevant to individuals are things such as the ability to take a 401k loan. That's only available under our solo 401k plan or a solo 401k plan that allows for loans, whereas the IRA rules don't allow anyone to take a loan from an IRA, regardless of whether it's a SEP IRA or a rollover IRA or a Roth IRA, that you just can't do it. With our solo 401k plan, you can invest in alternative investments with checkbook control. So for example, with our customers, we help those customers open up accounts at hundreds of different banks, many different brokerages where they have direct checkbook control. And so for those individuals that are looking to invest in alternative investments like real estate, that checkbook control is key because now they have that direct checkbook access. In other words, they can act quickly to take advantage of investment opportunities. And then the last thing we'll mention on this chart is the auto contribution tax credit. So setting up our plan will make the self-employed business eligible to claim $1,500 in solo 401k tax credits, $500 per year for 3 consecutive years, which more than covers our fees for the first 7 years. Whereas this auto contribution tax credit is definitely not available to a SEP IRA. So you have to have a solo 401k plan like ours that includes the auto contribution feature. Now keep in mind, the solo 401k participant, the solo 401k owner, the self-employed individual has the right to opt out of that default automatic contribution percentage. And that doesn't mean just because they exercise their right to opt out that they're not eligible to claim the credit. They most certainly are. And then opting out would then allow them to contribute in whichever amount or schedule they prefer, subject, of course, to the limits, the deadlines, etc. So now, before we turn to the good question, let's just take a look at a few case studies just to help answer that question, right? Solo 401k versus SEP IRA, which is right for you? So to illustrate some of these features and some of the differences, we'll go through a few case studies. So number one, the frugal investor, Sarah, independent consultant, annual income of $150,000, whose primary concern is minimizing fees while maximizing retirement savings. Sarah switched from a SEP IRA to a solo 401k after calculating that asset-based fees were costing her more as her account grew, because some of these SEP IRA providers will charge a percentage of the balance, right? So as the value of your account goes up, your fees go up. With the solo 401k, for my solo 401k, she only pays a flat annual fee and qualifies for a $1,500 tax credit. So our fees are not dependent on the value of your account. There's no asset under management fees, for example. Second case study is Mitchell, who's the Roth maximizer, has an annual income of $225,000, whose primary concern is tax diversification and future tax growth. Michael wanted mega backdoor Roth contribution options that weren't available with the SEP IRA. Remember, we talked about mega backdoor Roth not available because the way that you make mega backdoor Roth contributions is by making voluntary after-tax contributions. And with the SEP IRA, the individual can only contribute employer contributions. So by switching to a solo 401k, Michael can now make both traditional and Roth contributions, plus utilize the mega backdoor Roth strategy for additional tax-free growth potential. Next, we got Patricia, the large account holder. Patricia's a medical practice owner, $400,000 of annual income, whose primary concern is compliance and reporting requirements. So with retirement assets exceeding $250,000, Patricia needed Form 5500DZ filing support. So we handled this, right? So once the value of the solo 401k plan exceeds $250,000, there's going to be an informational tax filing requirement. The name of that informational tax filing form is Form 5500DZ. But we handle that as an optional free service. In other words, no additional charge for our customers. We do it under the electronic filing system, the EFAS system to make it easy for our customers. Next, we got Robert, who's the alternative investor. He's a real estate professional, annual income of $175,000. His primary concern is investment flexibility for real estate and private placements. Robert's solo 401k allows him to invest in real estate and private placements with checkbook control, allowing him to act quickly when investment opportunities arise. So we talked about that, right? And looking at the differences, right? With the SEP IRA, yes, it's possible. I mean, many SEP IRAs are through discount brokerages where they only allow you to invest in brokerage type investments. There are true IRA, alternative IRA providers who offer SEP IRAs that allow you to invest in alternative investments, but the IRA rules are different. They need to hold that IRA account. So that means you're not going to have checkbook control over that IRA unless you go to the trouble of setting up an LLC underneath your IRA. Whereas our solo 401k clients, the rules are different for them. They, as the business owner, act as the trustee of the plan, right? A solo 401k is a retirement trust. So they're the trustee of the retirement trust. And as such, they have direct checkbook access to the solo 401k account. There's no need to set up an LLC underneath the solo 401k to obtain that direct checkbook access. All right, so finally, we've got Lisa, the rainy day planner, e-commerce business owner, $200,000 of annual income, who's focused on access to funds if needed. Lisa values the ability to take loans from her solo 401k without penalties or credit checks, a feature unavailable with SEP IRAs. We saw that in the comparison, right? IRAs don't allow for loans, but if you have a solo 401k plan like ours that does, yes, our plan allows for 401k participant loans. So this allows the solo 401k owner to take money out of their solo 401k. They can use that money for any purpose. It could be for an emergency purpose or a business purpose or just a personal purpose. And as long as it's documented as a loan and paid back according to the loan terms, that's not going to be subject to taxes or penalties. So number one, we prepare the required loan documents as an optional free service for our customers. As far as the terms of that loan upon which it needs to be paid back, it needs to be paid back in either monthly or quarterly payments, equal payments of principal and interest. The interest is going to be prime plus 1% or a CD rate plus 2%, with those payments spread over a 5-year term. All right, wonderful. So again, if you found this helpful, please subscribe to the YouTube channel. It helps us get the word out. We do appreciate that. Thank you so much. So let's go to the questions. So I have dual employment situation with one W-2 employer with 401k and match, and another is my C Corp, where I also get earned income via salary and profit sharing. Is the employer and employer contribution limit of $76,500 applies to each employer or overall for both employer? Well, it depends. And we've got some more data here, some more context. So let's take a look at that. Example, employer 1, W-2 with 401k, W-2 wages, $345,000, pre-tax contribution made, $30,500. 401k match is 75% of 6% of W-2 wages, allows the after-tax contribution, profit sharing. Okay, no, I'm sorry. That's allows after-tax contribution. Now, then we've got employer 2, which is the self-employed business, the C Corp. From that business, there's $32,000 of W-2 wages, profit sharing contribution of $8,000, no pre-tax contribution, allows after-tax contribution. Okay. Then the question here is the $76,500 limit for each employer such that I can contribute after tax from employer 1 of $30,475 and for employer 2, $24,000. So let's answer that question. So the voluntary after-tax contribution limit applies at the plan level. So as long as those two employers, the owners, right, they're not related persons, right? The individual just works for employer 1, but owns employer 2, right? Employer 2 is the self-employed business. So those two businesses are not related, right? They don't constitute, for example, a control group. That means that the after-tax limit applies at the plan level. Now we need to clarify that the after-tax limit is really the overall limit. So the additional $7,500 that the individual is able to make because they're at 50 plus, that is an employee contribution. That individual could only make that $7,500 catch-up contribution one time. And it looks like in this case, they made it to their day job plan. So really the after-tax limit is not, for 2024, it's not $76,500, it's $69,000. So that's one thing to keep in mind. So even though the individual might have contributed $76,500 to their day job plan, that's not going to reduce how much they can contribute to the solo 401k as either an employer or an after tax. Now, they're not going to be able to make any more employee contributions to the solo 401k, right? Salary deferrals, because they already maxed out those $30,500 to the day job plan. But they could still make employer or voluntary after tax. Those limits apply at the plan level. So it's not reduced by contributions made to the day job plan. Now, another consideration here is that the ability to contribute to the solo 401k is limited. It's based on the self-employment compensation. Here, we understand that self-employment compensation is $32,000, right? That's the wages from employer 2, the sponsor of the solo 401k. So that means the most that can be contributed to the solo 401k is $32,000, right? You can't save more than you earn. So that means the most that they could contribute would be another $24,000 as a voluntary after tax. Because again, the voluntary after tax limit is 100% of the wages, the self-employment income, dollar for dollar, not to exceed the overall limit. Well, in this case, the wages are less than the overall limit of $69,000. So the most that can be contributed as an after tax would not be more than $32,000. But then on top of that, the total amount of contributions to the solo 401k between employee, employer, and after tax cannot exceed the lesser of the self-employment compensation or the overall limit. Here, they're not making any employee contributions to the solo 401k because they already maxed out those contributions to the day job plan. They've already contributed $8,000 as an employer, right? 25% of the W-2 wages. So that means the most that they could contribute is another $24,000 as a voluntary after-tax contribution. So what's really the limiting factor here are those wages from the self-employed business. If those wages went up to $69,000, they could contribute the difference up to $69,000, $8,000, $69,000 less 8, or they could contribute more as an employer, and then the sum could total up to $69,000. Hopefully that makes sense. Hopefully that helps. We really appreciate the good question. So again, we go live every day, once at 10 a.m. Pacific, 1 p.m. Eastern. If you found this helpful, we would really appreciate it if you would like and then subscribe on the YouTube channel to help get the word out. As always, all are welcome. You don't need to be a customer. We appreciate all the engagement. We, of course, appreciate the chance to discuss these topics. We also have our community. We've got over, we got thousands of forums on our community. It's a vibrant community. We have over 30,000 members on there. So come in. You can see what people are asking. You can ask your own question. Again, all are welcome. It's free to join. It's a great way to learn, to share the knowledge. All right. Until next time, everyone. Thank you so much for the participation. We do appreciate it.